All right, everybody, welcome to Finance 445. We're in week 3. We're still in chapter 15, which we will be in chapter 15 the entire mod. So, unlike most classes, we're going to stay in the same chapter the entire time. Today's segment of estate planning is going to be focused in on taxation of estates. And we've alluded to estate taxes. A lot of what drives estate planning ends up being, at least primarily, at least in part, taxes. But sometimes, they become all of the planning, or they become, taxes become a significant part of the planning. One of the things that's important to visit about is no matter how large someone's estate, right? We've talked about this $5.45 million that's excludable from our estate tax, and then if we're married, that can be as much as 10.9, right? We just double that. So we can have a lot of assets before we have any estate taxes due. But what about the person like Warren Buffett who, is worth, let's say, $50 billion, just to use round numbers. He's worth a little bit more than that, but let's say it's 50 billion. That's with a B. Most of us don't have a lot of sympathy for him as far as, the amount of taxes he has to pay. We're not too concerned whether or not his estate has to pay him, because even if his estate did have to pay the 35 to 40% tax that can be due on estates, he'd still have billions of dollars, to split between his children. But when it comes to his estate, there are ways for even him at his amount of money to completely avoid estate taxation. What he has to do, though, is some serious estate planning, and he's done quite a bit of it. We hear a lot about how he's given away the bulk of his wealth, and then he has this challenge for other billionaires, multi-billionaires, to do the same, the wealthiest people in the world. And there's this commitment pledge that a group of folks in his circles have made to basically give away the bulk of their assets. Now, before we think that they're just so charitable, basically the choice that they have is either they can give away their assets and get the tax benefits associated with that and reduce the taxation that they'll have to pay, or they can leave it all for their children and then pay a bunch of taxes. And most of these folks, they've taken care of their children. They've bought them houses. They've bought them cars. They've given them whatever they needed. They've given them their lifetime gifts each year. That exclusion, 14,000. And if they're married, they can do 28,000 for each one of their children, grandchildren, spouses, all of those folks. So there's a lot of gifting going on, and they're very well taken care of. Don't feel bad for them. But the point that I'm trying to make is that even with billions of dollars, they can still create a situation where when they die, no estate taxes will be paid. And that's through estate planning. And we're going to talk about some of the things that you can do tonight to accomplish that. We're also going to talk about how one can calculate basically for an estate how much tax will be due, or if there will be some taxes due. And so I think that's an important concept. We're also going to talk a little bit about a concept called Medicaid planning. And I think for the bulk of the folks, myself included, $10.9 million, we might feel like it's just very unlikely that we're going to have to worry about the estate tax, or that we're going to really have to be aggressive about estate planning from an estate tax perspective, because it's unlikely that we'll have over $11 million sitting around in our estate when we pass. And so it's unlikely that we'll have any estate taxes due. Now, having said that, it's important to understand the rules, right? Like we talked about, some people with small businesses, some small business owners, some people who own real estate, all of a sudden their estates are worth a lot more than what they expected. And so this estate planning becomes very important, almost by accident, right? Through a small business, or through some real assets like homes or rental properties or land that they have. Having said that, Medicaid planning can be something that can be applicable to all of us, almost all of us. And so we're going to talk a little bit about that and how attorneys use estate planning to basically plan ahead for Medicaid issues as well. Okay, so those are kind of the things that we want to do. Last week, most of you did very well in the class. All the grades are completed. So if you have any questions or concerns about something that hasn't been graded, let me know right away and we'll get on that. But most of you, as I mentioned, are doing very well, have most of your work in. This is, of course, over halfway, this point, and so always strongly encourage you to consider getting caught up. This is a good week to do it, as good as any. We've only got just less than 2 weeks now left in the course. That end That last Saturday on November 12th is going to come fast, as we know. And when it does come fast, we want to be in a situation where we don't run out of time, to get all our work in. So please plan ahead and work accordingly. This week, as far as the assignment is concerned, the assignment is pretty straightforward. It's a financial planning exercise at the end of chapter 15. And basically what it's doing, number 7 is doing, is it's testing you over your ability to take a scenario of information and then calculate out the tax associated with that information. So it gives you a worksheet, which is Exhibit 15.2 and 15.7, and then 15.8. Those 3 exhibits within the chapter you can reference in order to calculate for this particular situation the tax that would be due. Okay, so you'll want to understand what things are deductible, what things are part of your gross estate, which things are not. And we'll talk a little bit about that tonight. We're not going to go into great detail on that, but that's something that you can find in the chapter and then use to help you with the assignment. Don't be concerned about the page limitation or the page limit that needs to be associated with this assignment. Just make sure that you fully answer what it is that number 7 is asking for at the end of chapter 15, and make sure and demonstrate that you understand the concepts by using complete sentences and fully talking around the issues associated with those tax with the different scenarios and the tax associated with that scenario. Okay, if you do that, you won't need to worry about the page requirement, because if you answer it fully, I'll give you full credit. But once again, don't use that as an excuse to not really look into the chapter, reference the material, and be comprehensive as far as what you're doing to answer or fulfill the question. Okay. All right, so that's the assignment for this week, just number 7 at the end of chapter 15, financial planning exercises, and it's an estate where you're going to be calculating the taxes. This week on the discussion board, we've already got that started, so feel free to chime in and make our discussion boards good like we have already to this point, primarily because of your comments, and you guys have been doing a great job on that. So keep it up. Like I say, any questions or concerns about grading, let me know. The assessment, the test for this week is 25 questions, 2 points apiece, 1 hour to take it, all multiple choice. And as always, we'll take the last few minutes of class tonight to go through those questions and topics to make sure that you feel like you know at least what topics are going to be on the test. Now, similar to other tests that we've taken so far in this class, because we're only looking at chapter 15, excuse me, late night with Halloween last night. Because we're only looking at chapter 15, these tests have all been fairly comprehensive, meaning they all cover all of chapter 15. So even though we're focused in on tax this week, expect to see questions about anything from chapter 15, and since it's only one chapter, that should be reasonable and should be expected on your part. Okay? All right, so we'll take a few minutes at the end and go over those questions and topics, but let's go over some of the material, some of what the book has to say this week as it pertains to taxes. So a couple things to look at. So a couple topics that I wanted to cover, again, about estate planning, and we've alluded to some of these, but I wanted to talk a little bit more tonight about Medicaid planning, CRTs and CLTs, which are charitable remainder and charitable lead trusts. Okay. Then let's talk a little bit more about life insurance, how it works, and then let's talk a little bit more about tax planning. And of course, that's the gist of what the topic should be for the week, and that will bridge us into the next slide, which will go through how do we, when we're dissolving an estate, determine what the tax due will be. Okay. All right, so let's talk a little bit about Medicaid planning. In my overview for tonight, I mentioned that Medicaid planning might apply to more of us than estate taxes. And the reason for that is Medicaid planning, or the need for Medicaid, is fairly comprehensive and fairly significant. It's expected that about 2/3 of all Americans, all U.S. residents, will need at some point in their life long-term care. Okay, And that doesn't necessarily mean in an assisted living center. What it means is just some kind of ongoing long-term care. Could be in home health care, could be a family member having to assist them at an older age, or it could be what we typically think of when we think of long-term care, which is a long-term care facility, like an independent living facility for the elderly, or an assisted living center, or a rest home, a full service medical rest home. Okay. So, with that statistic, knowing that about 2/3 of us are all going to need some kind of assisted care or long-term care, it's then likely that most of us will have the expense associated with that as well, that somebody else just won't be doing that for free. More and more commonly, family members and caretakers just can't they can't handle it, right? I mean, it's just a lot. It's a huge burden to be put on a family member, and sometimes they can't. But sometimes, even if they can, it would kill them to do it, right? It would just take the life right out of them. So then we hire in help, either in-home nursing care or we go to an assisted care center. And as you probably all know, the costs associated with that are fairly extensive. So, just as an example, here in the state of Utah, we end up spending between $3,500 and $4,500 a month on assisted living. That's actually on the lower end of the national average. If you go into assisted care, you should expect between $40,000 and $50,000 a year or more, depending on where you live, for assisted living. Now, for a lot of people, if they have like a 401k and some savings in the bank, at $40,000 a year, if all they've got is, let's say, Social Security coming at a couple $1,000s a month, they're going to drain through all their savings very, very quickly. Now, once they've drained all their assets down to just $2,000 in assets, or $3,000 if it's a couple, and there's an exception for the home that they live in, but once they've drained down the assets to $2,000 per person, or excuse me, for an individual, or $3,000 for a couple, and that's in the state of Utah. Every state's a little bit different when it comes to Medicaid. Once they've drained basically all their assets, then they're eligible for the state to pay for their long-term care. Now, of course, the state is pre-negotiated with providers, and you're not going to get the nicest room necessarily or the nicest care, but it's nice that there actually is any kind of care at all. If you run out of money, there's a state program through Medicaid to pay for your assisted living center, if that's what you need. Okay, so what is Medicaid planning? Medicaid planning is saying, okay, there's a couple different things that are likely to happen. It's likely at some point, if you're a couple, that one of you will need assisted living, or even if you're single, that you'll need assisted living based on the statistics that we've already addressed. So how can you prepare for that? Well, either you can save a lot of money, you can basically self-insure, have lots of money sit in the bank, $1 million to pay for a nice facility over a long period of time, or you can buy long-term care insurance through an insurance company. Long-term care insurance will cover, basically, most of these policies will have like a daily benefit of like $100 a day or $150 a day, and that's for your assisted living or for your in-home health care. So you could pay premiums and buy an insurance policy. Most people do neither of those things. They don't have enough money to self-insure, and they also don't ever buy long-term care insurance. So they're in that middle ground where if something were to happen, they would have to spend down all their assets, and then in the end, after all their assets were gone, then Medicaid would step in and pay for their assisted living. Now, there's Medicaid planning is technically, from an advisor standpoint, illegal. What do I mean by that? Well, if you were to come to me, I mentioned I'm a certified financial planner at Zions Bank, and if you were to say, hey, Dave, can you come up with a way for me to basically hide my assets so that when I need assisted living, I don't have to use my assets, I can apply for Medicaid and get it? My response to you would be, that's illegal. I can't help you with that. Okay. And even if you were to say, if you use the line Medicaid planning, I'd say I can't do Medicaid planning, meaning I can't plan for you to be able to spend down all your assets so that you can have access to Medicaid. That's illegal. And even certain types of legal estate planning, as far as trusts and things like that, can walk a very fine line, because Medicaid programs obviously don't want to be taken advantage of. And so they've done a lot of things to prevent this. If you open irrevocable trusts, if you give to charity, if you give to your children, within 5 years of applying for Medicaid, there's what's called a look-back period. And the Medicaid can either penalize you for those gifts, or they can choose to just not give you Medicaid or not have you be eligible for Medicaid based on the fact that you tried to give away your estate so that you could get Medicaid within 5 years of you needing it. Now, gifts and transfers of assets that happen prior to 5 years before you apply for Medicaid don't have a look back period, and so those are legitimate and can happen. The problem is, and the reason they do 5 years is it's very difficult for somebody to plan ahead well enough to know, first of all, that it's going to be about 5 years out, but second of all, to basically give away or spend away all their assets 5 years in advance, which means you're going to live like a pauper for 5 years before you even need the Medicaid help, right? So basically what Medicaid is banking on is that people won't do that. They will spend down their assets to help them get the care that they need, and then when the care that they need has depleted all their assets, that's when Medicaid will kick in. Okay, so that's the whole issue of Medicaid. Medicaid's a government program run by states, okay, partially funded by federal government, partially funded by states. It's a program that creates a significant burden financially on the states, okay, on each of our states. And so it's a program that is always being looked at to try and make sure that the care is there for people who truly need it, but also not to be taken advantage of by folks who are just trying to game the system and take money out of the system when they really didn't need to, okay? So that's Medicaid. Now, because demographically or statistically, most of us will need assisted living or some kind of healthcare, long-term healthcare situation, and because Medicare only pays for about 60 days of that situation, most of us are either going to need to self-insure, buy insurance, long-term care insurance, or we'll end up on Medicaid. One of those three is going to happen for most all of us. Okay, so something to think about, something to plan for. If you can't afford long-term care insurance, it's something to consider, among other things. If you can self-insure, that's something to consider. If you know that you're going to be spending down your estate and then using Medicaid, just make sure and plan for that as well. Anticipate that. Some people that comes as a surprise when they have to move facilities because they were in a facility that costs more than what Medicaid's willing to reimburse, right, for their care. So just up to you how you want to look down the road and try to prepare for that, but I think it's a very important part of estate planning to address and come up with ways that you're going to anticipate and also deal with the costs associated, with long-term care that most of us are going to have. Okay? All right, that's Medicaid. Then we get to CRTs and CLTs, charitable remainder and charitable lead trust. Basically, these two types of trusts have the same objective, but a different way of accomplishing that objective. So both CRTs and CLTs, which they are referred to by their acronym, right? So if I say, hey, this attorney set up a CRT, that's lingo for charitable remainder trust, okay? And you can say it either way. It's just a mouthful to put it all out. So just know that I'm always referring to CLTs or CRTs, and I've given you the full name of what they are. They're both charitable in nature. And why are they charitable? Because they're trusts that accomplish an irrevocable gift that allow the person who's giving them to take a significant tax benefit for that gift, okay? So how does that work? Well, charitable remainder trusts have the corpus of a trust go to charity when the person passes away. So let's say I have $1 million in my estate. I don't want to give it to my kids. But I do want to make sure that I still have income during life so that I can live, right? I don't want to give away all my money and then not have anything to live on. So I put $1 million in a CRT. That effectively takes that money out of my estate. I'm able to live on 5% from that account, or $50,000 a year from the CRT for my benefit as long as I'm alive. And then when I die, the corpus of the trust, whatever's left in the trust, will go to the charity that I chose to direct it to. Okay? So why would anybody do this? Well, a lot of people want the tax benefits of a trust or taking money out of their estate now during life. They don't want to wait. They also want to be able to benefit charities at some point down the road. They wouldn't mind doing that. And if the money is in a CRT, it's not going to have any kind of estate tax. It's not going to be part of that person's gross estate, unless it's within 3 years, and we'll talk about that in a little bit, of them passing. So if you put money into a CRT, you effectively give it to the charity, although it stays in trust basically, or an escrow, you could say, giving you income to live off of while you're alive. And then when you die, the remaining balance, the remainder balance, that's why it's called a charitable remainder trust, goes to the charity. Okay? So it's a very effective way of getting money out of your gross estate and still accomplishing something that you want to do, like a charitable objective, and still accomplishing money for your own care, right? To not lose all control of the money that you need for your own care, day-to-day living. Okay, so that's a CRT. A CLT is a little bit different, charitable lead trust. What that means is that you're going to give the income, okay, from the, you're going to give the property, you're going to give the income from the property to a trust or to a charity, and then you're going to take the corpus is going to go back to your estate. Okay, so it's a little bit different, but they're just different in how they're taxed and different in how they're used. But the point of both of them is exactly the same, which is maintain some control over your funds still, even though you've irrevocably given them away, in essence, to charity, or at least a section of them to charity. And the tax benefits of both are significant when it comes to trying to remove assets out of your gross estate to not have to pay taxes on them. Okay, does not count towards your lifetime gift, right? Gifts to charity don't count towards that. So when we talk about $5.45 million in our life or death, right, that's our combined exclusion, we don't have to, we don't have to worry about any of these gifts that we've made to charity or charitable trusts. Okay, so that's the reason that CRTs and CLTs become important planning tools for folks who have money, still want to benefit from their money while they're living, but also want to get that money out of their estate so they don't have to pay estate taxes. Okay, so we talked a little bit about life insurance. I mentioned life insurance is unique when it comes to estate planning. It is one of the most uniquely good, tax-efficient tools that we can use from an estate planning perspective. Okay, so the reason that whole life insurance and guaranteed universal life insurance are such popular products and such good products, can be such good products, is from an estate planning perspective. Now, how they get sold sometimes is they get oversold, as you can imagine, by agents trying to make commissions. And they get sold as like this huge ability to accumulate value over time and then use your own money for yourself in life. And that part gets a little bit overdone and overplayed and oversold. When it comes to estate planning, I don't think you can oversell insurance. If somebody can qualify for insurance and is trying to maintain liquidity or pay taxes within an estate, or trying to get value outside of their estate by using an irrevocable life insurance trust, or what's referred to as an ILIT, if they use an ILIT, they're basically essentially taking that insurance and the premiums they pay into it and putting it into a trust for their beneficiaries or for their estate. And in doing so, they're levering the insurance company into a larger amount of money. So what do I mean by that? Well, let's say I pay $12,000 into a policy, an irrevocable life insurance trust that's gifted basically to my children. Well, I'm still under that annual gifting rule. And when the insurance pays out, let's say it's $1 million policy, the insurance pays out 100% tax-free, and that insurance death benefit was not part of my estate, is not taxable as part of my estate because it's in an irrevocable life insurance trust. In essence, I've gifted that policy to a trust, so it's not part of my gross estate. And I've taken some money, right, premium dollars, and expanded it into a significant amount of money on a tax-free basis for my heirs, to benefit my heirs, okay? So insurance can be a great planning tool from a standpoint of increasing the dollars that can be gifted to my family or gifted to charity without having to be part of my gross estate or without having to be part of that $5.45 million that I get capped out on, okay? So that's where life insurance can play a big role, and wanted to introduce the concept of an irrevocable life insurance trust, or an ILIT, okay? Finally, we want to talk a little bit about tax planning. Now, when it comes to tax planning and estate planning, there are a couple key concepts. We talked about how annuities are taxed and how they become taxable when they go through an estate. They're taxed as income. when it goes through an estate. Anything above the estate's basis or the decedent's basis, the person who passed away, what they put into it. So if I put $100,000 into an annuity, and when I die it's worth $200,000, my estate will have to pay income tax on $100,000, right? Because that's the growth beyond what I paid. Different than other types of investments like stocks, bonds, mutual funds, real estate, all those items, okay, do not get taxed as part of any kind of income tax. They get a step up in basis, meaning if I paid $100,000 for a piece of real estate and then it's worth $200,000 when I die, nobody pays any taxes on that growth, and the person who inherits it gets a step up in base, what's called a step up in basis. Their new basis is $200,000 even though they never paid for the property. Okay? So significantly more efficient to have assets outside of annuities than it is to have them inside of annuities when it comes to death planning or estate planning. Okay? Annuities have their own advantages and disadvantages that we talked a little bit about before. Annuities have tax deferral, annuities have guarantees as far as income, but as far as estate planning is concerned, not efficient at all. Okay. Then when it comes to IRAs, we talked a little bit about IRAs and Roth IRAs. IRAs have what's called a stretch provision when it comes to estate planning. That means that people related to us, our children or our spouse, can take on an IRA. A spouse can take it on like it's their own IRA, or a child, okay, if they're a beneficiary of an IRA, can either stretch it over their lifetime and take a lifetime beneficiary distribution over their expected life, or they can pull it out as fast as they want over 5 years, or they can pull it all out at once. Why would you even care the difference between those three options? Well, if I pull it all out at once, I'm going to pay taxes all at once. And if it's a big enough amount, it might put me in a different tax bracket. I might end up paying quite a bit more in income taxes, right? So IRAs usually will stretch them over at least 5 years, if not an entire life, so that we pay less tax over time. So that's IRAs when it comes to tax planning. Now, when it comes to Roth IRAs, which is a little bit different, right? Roth IRAs, 100% tax-free, go to my heirs or my beneficiaries from my trust, 100% tax-free. Okay, so that's a beautiful thing when it comes to Roth IRAs. There's no taxation, but I would argue that individual stocks, bonds, mutual funds, real estate, all those things are highly efficient from a tax planning standpoint, estate planning standpoint as well, right? Because all of them get a step up in basis. Nobody pays any income tax when I die on them, and then they get the step up in basis. My heirs do, and don't have to pay any tax on the purchase price that I paid. Doesn't convert to them. It steps up for them, okay, to a higher amount, so they pay less tax when they eventually sell it down the road. So if I inherit a house, okay, and then I sell it the next day, and it didn't go up in value in that 1 day period of time, I won't pay a dime of tax on inheriting that house. I'll get to collect all those revenues from selling the house and not have to pay anything on it because of how efficient assets like that move through estates. Okay? So that's some of the stuff I wanted to talk about from a tax planning or preparation standpoint. It's important whenever we're buying a product or service like an annuity or life insurance or mutual funds or stocks or an IRA that we have, when we're planning in retirement about any of those different products, we need to always be saying to ourselves, okay, what do these different products mean to me if I were to pass away? And do I really care? Some people just don't, they avoid the issue completely because they don't really care what happens when they pass away. They don't care if Uncle Sam gets a lot of their money, and it's the same reason that they might not do a trust or a will, because they don't care if a probate takes care of it. They don't mind the thought of attorneys taking their time, paying it out how they decide to pay it out, and having costs associated with that. But many of us, as we think through that, okay, I don't want it to be a public situation like probates are. I don't want it to go to places that probate decides it's going to go to. I want to have control over that. Those are things that we can accomplish, of course, like we've discussed before today when it comes to estate planning. Those are priorities of estate planning and things that we can accomplish through estate planning. All right, so let's talk about taxes. How do we determine the tax that's going to be due when it comes to an estate? And as we've mentioned a couple times before in this class, some of the material associated with the chapter is outdated, right? So as you're looking through the material, the tables are a little bit outdated. I was looking at a table earlier before the class. The estate table, tax table now, that's current. Let me just pull it up again. I just have an app on my phone to always have this stuff right at my hand because it seems like people are always asking me about tax questions. But there's a table now for estate taxes in 2016 that basically says if you have, let's say, above $5.45 million, you have another $10,000, right? So that's all you have above 5.45. Then you'd pay 18% tax on that 10,000. Okay. If you had $1 million above 5.45, so you had a $6.45 million estate, which means 5.45 was excluded from taxes, and then your taxable estate is the 1 million, right? You would pay $345,000 on that. So you'd pay basically a 34% bracket, or amount on the full 1 million. Now anything over $1 million, okay, so if I've got more than 6.45 million, meaning I've got a taxable estate more than $1 million, I'm going to pay a 40% bracket. So people with a lot of money, okay, maybe $1 billion, maybe 100 million, they're going to pay a 40% estate tax rate if they don't do some estate planning. Okay, so you'll give almost half of it to Uncle Sam if you don't do some estate planning. But anyway, the reason I bring that up is because we want to make sure that we're on top of the tables, right? Knowing that these tables adjust. Yes, you've got an assignment this week that has you use the tables in the chapter, and those are a little bit outdated. Still use them because the chapter asks you to, but know that there are other tables, more updated tables online, and that would be where you'd want to reference if you really wanted the exact numbers. So how does it start? Well, first of all, we gather all assets of an estate. Okay, so step one is we gather all assets of an estate. What does that include? It includes everything, right? We're talking about the value of the property, the value of any land or rentals, the value of any stocks, bonds, mutual funds, IRAs, the value of life insurance that's owned by the individual, okay? Not owned by an ILET, but owned by an individual. That is part of their gross estate. Any assets, retirement accounts, anything we add in as part of the gross estate. Then, how do we adjust for an adjusted gross estate? Well, there are things that are deductible from the gross estate, like funeral expenses, okay? So there are some one-off costs, accounting costs, things like that that can be adjusted out of the gross estate. They're not very significant though, okay? And then we take out our lifetime exclusion, which is that $5.45 million, okay, if we haven't used any of it before death, right? Because we can use it during life as well, that total exclusion amount. But assuming that we haven't used any of it, we can take out the $5.45 million from our gross estate as an exclusion. We can also take out any amount that we give to a spouse, right? You'll remember from previous classes, we've talked about the fact that there's an exclusion that's unlimited called the marital deduction. The unlimited marital deduction, which means I can give any amount that I want to a spouse, and it's not part of my taxable estate. It's part of my gross estate, but it's not part of my taxable estate. Okay, so after I've adjusted for some expenses, adjusted for any marital gifts, and adjusted for my exclusion amount, my total $5.45 million exclusion amount, then I get to what's called my taxable estate. Okay, so this is the portion of my estate that it's going to be taxable. Okay, then I get what my estate tax is on that based on the pretty complex table now. It's kind of like income taxes, but it's a pretty complex table. It's easy to look up, but it's not easy to remember because it's pretty complex. It's the one I just was describing earlier that tops out at 40% above $1 million. Okay, and we get to a point where we come up with how much we're going to have to pay. Then, okay, we take out any gift taxes we've already paid. We take out unified tax credit, any tax credits that we have. And that's what's due by our executor within 9 months of our passing. Okay. Now, there are all kinds of exceptions for that 9 months. If you have to get rid of property, or if you have to do different things, liquidate different properties to make it happen. But if there is an estate tax due, technically it's due within 9 months. Okay, there will be penalties and interest assessed if we don't get it done within 9 months. Now, one other quick side note to estates. Okay, everything in your estate is valued as of date of death. Okay, so when we're talking about a gross estate, we're valuing it as a date of death. But there's also an alternative date evaluation, which is 6 months from date of death. Okay, so this is kind of a strange situation, but if your executor waits more than 6 months, which they probably should, right? Just if there might be an estate tax situation, they're able to then choose date of death or the alternative date, which is 6 months from date of death, as the valuation date for your gross estate and for the transfer of assets. Okay. Now, why would you ever use that 6-month alternative date? Well, if everything went down in value over that 6 months, then you could use the alternative date and potentially pay less, right? But most people, most assets go up with inflation. Most assets go up, over time. And so most people are using date of death, not that alternative option. Okay? 9 months, got to pay estate taxes. Okay. A couple more things that I just wanted to point out. This is way too small on the slide, but this worksheet that's in the book I think is helpful to go through gross estate and then net out different expenses and get to the taxable estate and then actually calculate the estate tax due. So there's an example of that within the book, worksheet 15.2. I think that's helpful. The readings and tools for this particular week, there's a couple different things on readings and tools that aren't even really part of section 15.5 when they refer to different asset ownership types like joint tenancy. You'll remember joint tenancy with rights or survivorship, tenancy in the entirety, and tenancy in common are different ownership types of both businesses but also of property. And it does apply to estate planning because depending on how you own different assets, like a home, for example, if it's joint tenancy with rights of survivorship, okay, then there's no reason for probate and there's no reason for actually even a trust if you just want it to go to your spouse if something were to happen to you. Okay, because joint tenants with rights of survivorship will allow that to happen. Tenancy in the entirety and tenancy in common are a little bit less common, especially among married people, but different ways that ownership can happen, and where legally and contractually property will change ownership according to that ownership type, as opposed to having to have a will or a trust for that. And usually we're talking about real estate, right? Could be a business, but usually we're talking about title ownership as far as land, our home, rental properties. When we title them that way, then they move without us having to do anything through an estate. Same thing is true for a life insurance product with a beneficiary. Same thing is true for checking, savings, money market, CD, those types of accounts through a bank. When we've established what's called a payable on death or transfer on death agreement, TOD or POD, those are the acronyms for those types of products. When we put those beneficiaries on, those legally pass outside of needing any kind of estate planning, probate, or a trust to take care of them because they've got contractual beneficiaries assigned to those products. Real estate, okay, so title, right, property title cannot have beneficiaries. It can have joint ownership, but it can't have beneficiaries. So the only way to pass real estate is through probate if there's no joint tenant to give ownership to. So if both joint tenants die, it's got to go through probate. If one owner and it's an individually owned property dies, then it's got to go through probate unless it's titled or owned by a trust. Okay, so that's where you avoid that through trust. But that's just talking about real property where there's a title on it. If it's joint tenancy with rights of survivorship, just goes to our spouse 100%. If it's individually owned, then we need a trust or a will to make sure and dictate where that goes, or probate will. Okay? All right, let's look at assessment 3, the 25 questions that are going to be on the test this week. So one sec. Let me pull it up. We'll get you the topics that are on this week. All right. So as I mentioned before, 25 questions, mostly true, false, and multiple choice. Pretty straightforward. But like I say, anything from chapter 15 is fair game. Just keep that in mind. Don't get caught up thinking it's only going to be about taxes. So, and this is just me again. You don't have to do this, but if it were me before the test, I would read through the entire chapter. Again, it's not a long chapter. It's not hard material, but just refresh through it. Just read through it before you get to the test, and then these 25 questions will go a lot faster than if you don't review, don't take any notes, and just try to wing it the best you can and try to find answers as you go. Then you might run out of time. But if you've already prepared based on the notes that we give you tonight with the topics, and you've already reread the chapter, trying to look purposefully for the answers to the different topics and information about the topics that I mentioned will be on it, then you should be in great shape. So let's start. Number 1 on the test. Number 1 on the test just asks you about if you die intestate, what does that mean? Who dictates where your assets will go? What does it mean? Okay. Number 2 on the test talks about, this is a question that we talked about in week 1. Who needs a will? What does the book say about who needs a will, I guess, is the better question. If we know what the answer to that is, or what the book has to say about that, we'll get number 2 right on the test. Number 3 on the test. Number 3 on the test talks about the intestate process or the probate process. Is it federally mandated and the same from state to state, or is it different from state to state? Okay, so that's that's what does the book have to say about how this process goes? Is it the same from state to state, or is it different from state to state? Number 4 on the test. Number 4 on the test is a little bit tricky. It says the federal estate tax is similar from state to state. The federal estate tax is similar from state to state. This is kind of a trick question. The answer, according to the book, is false. Reality is the federal estate tax is exactly the same no matter where you live in the country. And so I don't know why this question is asking and answering the way it is. So number 4 on the test is false according to the test, but just know that federal rules associated with the estate tax are the same from state to state. Okay, it's a federal rule. Now, how probate works is something that can be unique state to state. Okay, but federal estate taxes are going to be the same no matter which state you live. Now, maybe what it's asking is, or maybe what it's trying to ask on number 4 is, do states have different rules as far as inheritance tax or death taxes? And the answer is yes. Some states have an inheritance tax on top of the federal estate tax. Some states do not. Okay. Some states tack on an extra estate tax. Some states don't. Okay. But as far as the federal estate tax, that's the same no matter where you live in the country. You just might have state laws on top of it. Number 5, pretty straightforward question. Just how do you do estate planning? What's the first step? Obviously, you got to gather information, and you need to know a lot of information about a lot of things to do the right kind of estate planning for somebody. Number 6, who is a testator? Who is the testator of a will or a trust? Number 7, what is the appointment clause? What is the appointment clause? Number 8, what are different considerations for picking a trustee? Talked about this in previous weeks, but what are the most important things when it comes to picking a trustee for your trust? Number 9, who is the personal representative for a decedent? So if somebody passed away, who is their personal representative? What's the terminology we use when it comes to estate planning for who the personal representative of the person who passed away is? Okay. Joint tenancy with rights of survivorship can apply to who? What types of owners? Does it have to be somebody who's married or not? One of those entity types that I mentioned, so there's joint tenancy with rights of survivorship, tenancy in common, and tenancy in the entirety. One of those has to be a married couple. Make sure you understand which one that is before you get to the test. Number 12, which types of ownership don't have rights of survivorship out of those different types? Number 13, what is a living will? And you'll get that one right. talked about the difference between a will, right, that dictates our stuff, and then a living will. What is a living will? That's very different. Number 14. What does the book say about what a credit shelter trust is? What is a credit shelter trust? Another question on 15 about tenancy in the entirety. Do you have to be married or not? Number 16, if you reserve the right to change a trust, then it's revocable, starting with an R. If you don't have the right or control over a trust, then it's an irrevocable trust, right? A completed gift trust. That starts with an I, and those have less control. Just make sure you understand the difference between those two types, revocable and irrevocable trusts for number 16. Number 17, another name for trustee is, according to the book. Just be able to answer that. Number 18, all kinds of different types of trusts. Just make sure you know what the book has to say about this as far as different types of trusts that are out there. Then there's going to be a bogus one that you need to be able to identify. So just be able to identify the ones that are on the list that the book gave you, and you'll be able to identify the one that's not, right? Number 19, another question about picking a good trustee. What are good traits of a good trustee? Number 20, different advantages of giving lifetime gifts. Just make sure you understand what the book has to say about the importance or advantages of giving lifetime gifts. Those are gifts that we give during lifetime. Doesn't mean that we give them for our entire life, right? Just any gift we give in life while we're alive is a lifetime gift. Okay. All right. Moving on. What makes a will valid or invalid? Okay. There is a list of different requirements of a valid will in the book. Just make sure you understand what those are so you could identify a true-false question on number 21 for something that would invalidate a will. Number 22, again, a requirement of a will. Number 23, what is a codicil? What is a codicil? C-O-D-I-C-I-L. I've heard attorneys pronounce it different ways, but what is that? Number 24. Number 24 requires that you understand what the book has to say about a new will or a new trust, what that means for a previous will or trust. Okay? What does it mean for a previous will or trust when we create a new one? And it's pretty, I mean, should be pretty straightforward. We got to assume that the most recent one is the only valid one, right? So if you go into mother-in-law who passed away's house and you're going through her files and you come across a will from 1999 and then someone else comes across a will from 2008, the will from 2008 is going to supersede the one from 1999, and the 2008 one is going to be the one that's followed. Okay? Now, does the 2008 one have to say something like, this will nullifies any previous wills? The answer is no. It doesn't have to say that at all. Just because it's more recent makes it the only valid will and delegitimizes any previous will. Okay? Same with trusts. Number 25. Number 25 has to do with what divorce does to wills. Okay? What does divorce do to a will? How does a divorce affect a will? What does state law dictate that a divorce does to an existing will between a couple? Okay? What does the book have to say about that? And you'll have number 25 right on the test. So pretty straightforward questions, all out of chapter 15. If if you've looked for answers based on listening to this and jotting down the topics, you should be in great shape. Should go fairly quickly as well. If you have any questions this week as you go through the material, let me know. Like I say, the assignment should be pretty straightforward. Just a quick calculation on estate taxes with some tools, some different exhibits from the chapter that are very helpful that just make it pretty straightforward. You just need to plug those numbers in that the scenario gives you and then calculate it out. Double check it, submit it, and we'll get you full credit for that if you've got things where they should go. Now make sure and show your work. Don't just give me the answer, the calculated answer to what the estate tax that's due. Show me and explain through what you're doing step by step, so that once again you demonstrate that you understand the why, right? Because that's definitely part of these assignments. And keep up on the discussion board. Get caught up if you've got things behind. Get with the learning coach if you need to. Lindsay Hawes this week. Her information is on the announcement board already. And good luck this week. I hope everybody does well. And if you get stuck on anything, let me know and get in touch with me. Have a good night.